like many of you here, is a polymath. He's been a banker. To his discredit, I'm afraid, he's also been a regulator. But he's now a consultant at EY. So I think what I'm going to do is ask Tom to speak. The form I understand, and certainly the speakers would prefer this if you hold your questions until after they have, each individual one have spoken, but after each individual speaker has spoken, I will look to the audience if anyone would like to ask questions then. So Tom, the floor is yours.
Thank you very much. First of all, my apologies for the confusion and for the late arrival. It perhaps has the advantage that I escaped Charles's chairmanship and scrutiny, but as I see he's in the audience, will not be the case. What I'd like to do is talk about the capital. And when will banks have enough? Two different schools of thought, not surprisingly. The banks think they have more than enough. A wide variety of critics, Professor Vickers, for example, think the banks have too little. Martin Wolf, another prominent example. And a few lone voices, Mark Carney, for example, as chair, in his role as chair of the FSB, think banks, thanks to the reforms that the FSB has sponsored, have just about enough. And well, if you look back, how would you judge this argument? Is the question I'd like to spend a few minutes on this afternoon. And surprisingly, there is not an agreed standard, or at least in my mind, an agreed standard by which to judge that. And that used not to matter. In a world of deposit insurance and too big to fail, essentially deposits were guaranteed, banks were quasi-government agencies, and effectively they were reckoned to be too big to fail, and therefore the question of the basis on which the capital was calculated, as far as the depositors was concerned, was secondary. The government was standing behind the banks, and we found that to in fact be the case during the crisis. Now, as part of the reform post-crisis, we're supposed to put investors at risk. That has by and large been done, or a very significant start has been made on that through resolution reform. Capital has been strengthened. But what is the right way to judge whether banks have enough capital or not? And I think you get into the question of, well, how safe do you want deposits to be? And that to my mind is the critical question, and then to look through the corporate finance and discipline to say what type of mechanism has been put in place, is it enough? Deposits at least by my reckoning and others, should be pretty much immune from loss, and ideally they should be exempt from suspension. In that respect, they would be able to fulfill the critical economic function of making payments and facilitating economic activity. That is the objective. And in ratings terms, immune from loss would translate into AAA. Immune from loss and exempt from suspension would translate perhaps into quadruple A. And if we take that standard, if we agree for a moment that that is the standard, perhaps what I'd like to do is question how far we have gotten towards those objectives. I would submit we've gotten very far towards immune from loss. If you look at the depositor preference plus the imposition of total loss absorbing capacity requirements that should, particularly where there is an element of liabilities between deposits and the total loss absorbing capacity, give deposits sufficient protection to make them immune from loss. So there's enough assets to cover the deposits. The real question, to my mind, is exempt from suspension. So that if the bank does get to the point of what's called a point of non-viability, how can you assure that the depositor continues to have access to his deposits and continues to be able to transact? And here, there are a couple of elements I think that are important. The first is prompt intervention, having the resolution authority get in while the bank still has positive equity, so that there is something to be saved. And I'll come back to the valuation question in a minute. Liquidity, enabling the bank in resolution to have access to liquidity, and creating a mechanism to provide for a smooth resolution process. Now, there's been an elaborate construction of what I would call a pre-pack approach towards resolution. It involves bail-in, conversion of investor obligations into equity, stays on qualified financial contracts, access to financial market infrastructures, etc. There are a lot of moving pieces. It is fairly well mapped out, but all of those pieces have to operate smoothly, at the same time, and in conjunction with one another. It's untested, and the possibility that it won't work cannot be ruled out. So what I try to do is to think about, are there mechanisms that will make things easier in a resolution environment, so that there is a greater assurance that one can still allow depositors to have access to their money. That, if you like, is the exam question. Three elements I think are important. The first, as I said, was valuation. And here, significant improvements can and should be made. There is, in some cases, as we've seen in the Italian bank episodes, an elaborate amount of time is spent worrying about what the valuation of the balance sheet at year end was sometime in 3-4 months later. Figuring out to the last basis point what the capital ratio is with a lag of 3 months, I would submit is pointless. It's much more important to have an estimate within a percentage point of the capital, of the real capital, very frequently with a very short lag between the balance sheet date and the valuation. So that window has to be compressed, and there has to be a better ability to monitor the condition of the bank, and a better capability for the authorities to move in a prompt manner. That's number one. Number two when the bank comes into resolution, if access is going to be continued to be available to deposits, the liquidity that the bank will need in order to pay out deposits and that people want to withdraw has to come from somewhere. And the resolution plans that have been developed are missing this very important point. And it is not a point, I would submit, that the banks themselves can completely solve. The central banks, in my opinion, have to come to the table and have to say that they are willing and able to provide liquidity against collateral that the bank in resolution may have. And to date, most central banks have not been willing to make that statement. The resolution plans are the plans of the authorities. They're not the plans of the banks. The banks furnish the data, the banks can make suggestions, but when it comes down to the resolution, it is the authorities that call the shots. And I would submit much more certainty with respect to the willingness of the central bank to provide liquidity in this situation is required. The third element is whether one can do something to avoid the necessity on a resolution weekend to go through an elaborate and very hasty calculation of the ratios of conversion or write-down that would need to occur to take investor instruments such as subordinated debt or senior non-preferred debt and to translate that into equity on that same weekend. Believe me, the resolution authorities are going to have more than enough to do. Figuring out what the conversion ratio should be is not necessary at that weekend. And therefore, can one develop a mechanism that would facilitate of pushing that problem off to a restructuring phase and making it a problem that is much more akin to being solvable in a manner that allows some rights for the investors in the bank obligations, in the TLAC obligations, to have a voice in how this is going to be restructured. I think the Bank of England has proposed a use of receiver certificates. I think that has considerable merit. The question that is raised is, suppose the losses are so great that the equity is exhausted, does the bank therefore become insolvent? Does that void the ability to use receiver certificates and force some type of conversion immediately so that one has a solvent institution to deal with? At least that's the dialogue as I understand it. And the question I raised in the paper that is in a very preliminary stage is whether one can think about borrowing a concept from securitization vehicles where they have what I call a plug, a small piece of equity that stays in place. It does not bear loss. It does not receive dividends or distributions. It just stays put so that the institution can remain solvent at all times. And I would call this continuity capital. You don't need much of it, certainly not in securitization structures. It has proven to be effective, at least is my understanding, as a mechanism to keep things in place. And I would suggest that one be able to look at that. So if we to recap, in the world of resolution reform, one has to ask with respect to capital, if we're going to ask how much is enough, what standard do we use? And I would submit a reasonable standard is for deposits to be immune from loss, and for deposits in addition to be exempt from suspension. I think the current levels of capital go very far, indeed reach the immune from loss target. More is needed on the exemption from suspension side, and that's where I would suggest regulators, supervisors, and bankers, as well as central banks, focus their attention. Thank you very much.